If you borrowed money off someone and they wanted to give you it back plus a little bit extra, then you take that every single day. And that's precisely what the Bank of England has just told banks to get ready for. But does that mean that we're all going to get free money in the next few months? Hi guys, Anthony here and welcome to another video. As you know, on this channel I talk about everything personal finance and investing from the perspective of a professional working in the world of finance. Recently, we heard news that the Bank of England has told banks to get ready for negative interest rates. Working in the world of finance and doing deals worth hundreds of millions of pounds, I can see how tiny moves in percentages of an interest rate can really blow up a whole deal. So what do negative rates really mean? And can you and I take advantage of this? When you and I go to our mom and dad, brother, sister, girlfriend, boyfriend, and ask to borrow money, then they'll just give it to us. But they will say, give me back whenever you can. And normally if you're a good person, you'll give them back their money. Seems like a relatively nice and normal thing to do. However, when we want to buy a house or a car or something really big, we don't really want to keep asking our friends and family for more money. At that point, we go to a bank. And for the privilege of having that money, you have to pay us a certain percentage of the amount that you've borrowed each year. And that percentage is called your interest rate. What we're hearing recently is that the Bank of England is getting ready to introduce negative interest rates. For example, if you were to borrow money to buy a house, if you have a negative interest rate, the bank will pay you. That sounds like a no-brainer and a fantastic deal. But does that mean that you get paid to have a mortgage? Well, negative interest rates aren't quite as good as that. They are good for people who have mortgages. However, there are some strings attached and really you won't get paid by your bank to borrow money. What has really happened is that the Bank of England, the central bank in the UK, has introduced negative interest rates. What that really means is that between a normal bank, so your high street bank who has your bank account, and the Bank of England, that bank will be provided a loan which is negative interest rates, which means that the Bank of England will actually be giving that bank money to lend. So before you think, hold on a second, you're telling me that my mortgage isn't going to be paying me and then my bank is getting money free from the Bank of England, how am I going to benefit? So let's just remember that there's loads of banks out there, and if your bank isn't giving you the best deal, the bank next door will. And that is how you benefit from negative interest rates. We'll also be benefiting the bank if they kept all the interest rates at the same price, that actually what they'll do is they'll pass that on to consumers. What you have to think about is that banks are competitive businesses. There are lots of banks out there, and if you find a cheaper rate, you'll just go straight for that rate. So that's all good news then. If your bank's being paid to borrow money, then you should be paid. However, as I said before, banks are businesses, so they actually earn a few percentage points over how much money they bring in. But still good, because it means that the amount of money which you'll borrow and the rate in which you'll pay will be a lot lower. So that's great news. It's great news if you have a loan out for your business. Great news if you have a loan out for the mortgage on your house. Great news if you have a loan out for the mortgage on your car. But does that mean it's great news for absolutely everyone? Well, of course not. If you're putting money into a savings account, then that savings account is just earning less interest. So overall, why are the Bank of England doing this? Is this good for the economy? Well, yes and no. The whole reason the Bank of England are doing this is to inspire growth in the economy, to make people spend more money, to businesses spend more money, produce more things, to sell more things, to make more money, so that we can all go back to our normal lives where we are just raking it in. And the more money there is, the more that people spend, the better the economy is for all of us. It means that people are going to shops, people are going to restaurants, people are buying clothes, and people are employed. It's also really good for people who have loans. If you have negative interest rates, which means the bank passes that on to you, so you have lower interest rates, means that you'll have to pay less every month or every quarter on the loans that you've taken out. And as I said, this is great for businesses as they can take out bigger loans to invest in projects which they wouldn't really have invested in previously. However, like the finance guru Notorious B.I.G. says, more money, more problems. That more money in the financial system isn't good for everyone. Having really low interest rates isn't good for savers. If you've got lots of money in a savings account and thinking that you want to earn a few percentage points each year just by leaving it in the bank, then unfortunately, that just isn't going to happen. What you will then find is people will be taking that money out of their bank account and moving it onto other things. The Bank of England's hope is that you take that money out of your bank account and then you spend it in a shop, on a holiday, on whatever, to stimulate the economy. But this actually means that it's bad news for banks. How banks work is they take your money in and then they lend it out. How they make money is that when they have your money in, they pay you a small percentage on that money. And then what they do is they lend it out at a higher percentage. Now, if people are taking their money out, it means that the bank has less money to lend. So although it can do it cheaper, it actually doesn't make more business. And if you own bank stocks, then you could be looking at some very troubling times ahead. And if banks can't be bringing money in from customers, it means they can't be lending it out, and then they can't be generating a profit, which means that they can't be making money. So overall, what we have to think about is negative interest rates are a bad sign for the economy. If the Bank of England introduces negative interest rates, as it said to banks that it might do in 6 months' time, it means that the British economy is really suffering, which means that we'll probably be in a lot worse place than we are now, which means that we need all the help we can get. And there's one easy way in which you can make a great investment decision and get all the help you can get, is by hitting that like button and turning that thing blue. Having negative interest rates is great news for people who have loans. It means that your interest payments are lower each and every month. And who doesn't want more money? And ultimately, it's also good news for the stock market. Because there'll be people who are earning next to nothing in their savings account, they'll just take that money out and invest it into the stock market, which is great news, unless you're investing into banks. That could be rather tricky. But if you're investing into the stock market, that is by far the best way which you can avoid being affected too much by negative interest rates. Because your money is directly invested into companies that will hopefully be able to borrow at lower interest rates, it means they can use that debt to invest in projects which beforehand wouldn't have worked, which hopefully in the future means they make more profit. So that's a win-win for everyone who invests in those stocks. So overall, this means one thing: make sure that all of you are investing, that you're not holding that money in that savings account earning next to nothing on interest, that you've got your money in the stock market making money for you, because that is the best way to make sure that you are sheltered against the fall of interest rates. So there you go. That's how negative interest rates can impact your money and how you can make the most of it. If you have enjoyed today's video, please make sure you hit that like button. And if you want to see more content from a finance professional, hit that subscribe button. And don't forget, follow me on Instagram at Anthony Cotter Finance. And I'll see you next time.